Vancouver-based OceanaGold is trading slightly higher at the moment after missing fourth quarter earnings estimates despite record revenues. The company is tripling its quarterly dividend and expects higher production this year. So for more, joining us now is Gerard Bond, President and CEO of OceanaGold. It's good to have you join us. Thanks so much.
Thank you, Lindsay. Great to be on this program.
So you've tripled your quarterly dividend. You've approved doubling of share buybacks to $350 million for 2026. What do some of these decisions mean, or what's behind some of these decisions? Does it mean you're going to focus less on M&As?
Well, what it means is that the business is performing really, really well. And, the management over a number of years has had a plan how to get the portfolio right, get the assets performing as we've intended to, deliver on our production guidance. And what the increase in capital returns to shareholders shows is that we're confident in the future of the business, our performance, our growth, and with the strong balance sheet that we have, and given the returns that we've generated to the bottom line in free cash flow generation, it's timely to give more back to the shareholders.
So will you be focusing less on M&As and also CapEx for 2026, or not so much?
Oh no, we're investing much more in growth projects and much more in exploration in 2026. We've got a really exciting development called the Waihi North project in New Zealand. That's one of the world's best undeveloped gold mines, and so we've got the permit and we're going at it at full strength this year. We also have the Palomino underground development at Haile that we're investing in. M&A, to answer your question, I mean, that's something that we always have a look at to see what's available. At these prices, it's obviously harder to find value in acquiring other assets, but we do scan. We look at everything.
Okay, yeah, you were mentioning some of those mines in the analyst call today. You also touched on labor cost inflation in that earnings call today. How much of an impact do you expect labor cost inflation to have in the year ahead?
Well, it's reflected in our guidance in the year ahead, which I would say that our overall all-in sustaining cost is expected to reduce by 7% year on year. That's as a result of greater production coming out of our largest producer in the Haile gold mine. On labour costs, we have real inflation that we have to deal with to keep our workforce appropriately paid. It's in low single digits. Labour is about 50% of our cost base, so we're seeing low single digit inflation in our cost base. But as again, our 2026 all-in sustaining cost year on year is projected to be 7% lower.
Okay, yeah, and I know you say that's reflected in your guidance. You're also forecasting a 12% increase in output for 2026. I'm wondering, will labor costs factor into that at all?
No, it's quite the opposite. So we have an assumption about labour costs. So we're assuming our labour costs will rise with inflation of around 5%. And the increase in gold production that we're producing out of the Haile gold mine, 35% increase year on year. That unit cost reduces as a result of that growth in overall gold production.
Okay, got it. When we're talking about overall gold production for 2026, you say you're increasing production. What's your outlook, though, on gold prices and demand for 2026?
Look, the gold prices that we have today at around $5,000 an ounce are much higher than the $3,500 an ounce that we had in 2025. And that was a year where we made a tremendous amount of record free cash flow. I see the gold prices being around the $5,000 an ounce mark, could be higher. All the factors that have driven gold price to these levels seem to be still present. Central bank buying remains strong. De-dollarization remains a theme. Stagflation remains a risk. And geopolitical uncertainty remains high. So we don't set our business activity by reference to a gold price. We focus on safely and responsibly delivering our production guidance, keeping our costs low, maximising the cash flow generation. But certainly at these gold prices, we're primed to deliver even more free cash flow than we did last year. And that was a record.
Okay, so then my next question was going to be like, what should the price of gold be for you to reach your dividend and buyback goals? But I take your point. Like you say, you don't really set your goals based on the price of gold. Is that right?
That's correct. And so at a price of gold even lower than it trades today, we're confident in being able to triple our dividend. We're confident in being able to double our buyback program. That gives a 112% increase in the $200 million that we gave back to shareholders last year. So we're really showing confidence in our business. We're showing confidence in the margins that we make from our activity and the future of the company.
Something also interesting is you plan to list on the New York Stock Exchange in April of this year. Why is that? Like, is the TSX falling behind as an option for Canadian companies, even mining companies, which obviously material stocks do quite well on the TSX?
Yeah, I mean, we've long been listed on the Toronto Stock Exchange. What we have uniquely is 50% of our gold production is based in the USA. And the USA is also the world's largest, deepest capital market. And we think that by listing on the exchange, in addition to remaining listed on the Toronto Stock Exchange, we will increase the universe of potential buyers, improve liquidity, and that drives value for our shareholders. But this unique calling card, as it were, of having 50% of our gold production coming out of the USA just compels us to be on the New York Stock Exchange.
Okay, Gerard Bond, President and CEO of OceanaGold, joining us. Appreciate your time today. Thanks so much.
Thank you, Lindsay.